Okay, you have questions?
Yes, sir. I'm sending you.
Okay.
Yes, sir. Sent.
Okay. So these are the questions, right? First one. Assume that the nominal spot exchange rate increases by 7.5 percentage, the Eurozone price level decreases by 4 percentage, and the US price level increases by 2.5. The change in the real exchange rate, okay, is closest to price level, change in the real exchange rate. Okay, see. Remember, I told you one equation, nominal rate is equal to inflation rate into real rate,
Yeah.
right? So nominal rate is increasing by 7.5 percentage. That is equal to inflation rate. So USD is in the numerator here. So USD's price level is 2.5 percentage increasing. Price means inflation, 2.5 percentage. And decreases by 4 percentage. Now, can you solve this now?
Yes. 0.7%.
Real exchange rate, so check.
Yes, sir. Yeah, it's 0.7%.
Understood this one?
Yes. I didn't understand a real rate. Okay,
Purchasing power.
yeah.
Real rate means purchasing power. That means with the base currency, how much domestic current with the base currency, how much price currencies goods can you purchase for?
Okay.
That means it is changing by 0.7 percentage. That means you can buy more now by 0.7. Hello, is it
Yes.
okay? Understood this one?
Yes.
Over the past month, the Swiss franc has depreciated 2% against the British pound. How much has the pound sterling appreciated against Swiss franc? Okay. Over the past month, the Swiss franc has depreciated 12% against the British pound. How much has the pound sterling appreciated? So, first of all, it says it depreciated by 12%. So, you take opening price as 100. So, closing price will be what? Depreciated by 12%. No? So, it should be 88. Okay, so 88 by 100 minus 1 is equal to 12%. Just check. Is that right? 88 by 100 minus 1 will come to 12%.
Yes.
So that means if British pound is 100, this is GBP and this is Swiss franc, CHF. Okay.
Okay.
Now the question is, how much has the pound sterling appreciated against the Swiss franc? How much has the pound sterling appreciated against the Swiss franc? How much has the pound sterling appreciated? Okay. So if you want to know about the numerator, okay, all you have to do is this is closing by opening. So make it opening by closing value. Just calculate now. I think this part I have not told you, so I will explain it today. But you just calculate now.
0.1364, so 13.64%.
So which is more than 12%. Is it matching? Check.
Yes, sir. Yeah.
I'll just explain this part now because I have not told this to you before. See, but it will come today. I was supposed to explain. See, say for example, right now $1 is, let's say 90 rupees. $1, and in a year's time it becomes 92 rupees. Now dollar is appreciated or depreciated?
Appreciated.
Yeah. So dollar is appreciated and rupee is depreciated. So appreciation of dollar is equal to what? That is base currency. So base currency is equal to closing value divided by opening value minus 1. Okay. Just calculate.
2.22%.
2.
22%.
Okay. Now if I want to know, this is appreciation percentage,
Yeah.
depreciation percentage of rupee, that means price currency. Now should I say 2.22 percentage dollar is appreciated, that means 2.22 percentage rupee is depreciated? That will be wrong.
Yeah.
Okay, when it comes to forex. So for depreciation of rupee, the formula changes to opening by closing value minus 1. Okay, so opening value is 90 by 92 minus 1. Okay, now why it changes like this? Because see, whatever you want to calculate, like appreciation, depreciation, that should be the base one. So here already this is the base one. Okay, here this is the base one. So I directly took closing by opening. But if I say rupee, so rupee point of view, actually how it should be, just calculate this. This is a shortcut way I told you. Now I'll tell you the long cut way also. Then you will understand why the formula is like this.
This is 2.17%.
Huh. So this is depreciation. So I can write as minus sign also. Depreciation. Okay. But why like this? In case you are wondering, see, whichever we are finding appreciation or depreciation, that should be the base currency. But now dollar is the base, but I'm finding for rupee. So I should convert rupee into base. So that means for 1 rupee, what is the dollar? Calculate. So 1 by 90 you do.
0.0111.
And this is 92.
Yeah.
1 by 92.
Point 0.0108.
0.0108. So now you follow the normal one, closing by opening, because now rupee is in the denominator. So 0.0108 divided by 0.0111 minus 1. You see, you will get 2.17 percentage.
Yes, sir. Yeah.
Actually, this is the right way, but that will be more time consuming. So instead, we are doing like this. Whichever way you are comfortable, you may do. Is it okay? Done?
Yes, sir.
An exchange rate between two currencies has increased to 1.45. If the base currency has appreciated by 8% against the price currency, the initial exchange rate between the two currencies was closest to. The exchange rate between two currencies has increased to 1.45. The exchange rate between two currencies, okay, has increased to 2. Okay. If the base currency is appreciated by 8% against the price currency, the initial rate between the two currencies was closest to. Okay. Mm. The percentage appreciation of the base currency can be calculated by dividing the appreciated exchange rate by the initial exchange rate. Okay. If the base currency is appreciated by 8% against the price currency, the initial one, the exchange rate between two currencies has increased to. Okay. Exchange rate between two currencies has increased. The base currency is appreciated by 8%. Okay. So 8% base currency is appreciated. That means we know closing minus opening. Okay, that is closing divided by opening value. So, if base is 100, it must have gone to 108. Correct? No, if the base is, that will not come to, if the base is, this is 100, this should be 92. Then only it will come to 8%, right? Just check. No. This is 100 base and this should be 108. Check now. 8%. Just check.
Yes, 8%.
So if this is the closing value and this is the opening value, okay, the base is 100, 8% up, that means it must have gone to 108. Now, after increasing, they're saying an exchange rate between two currencies has increased to 1.45. So, now how do I use this number? If it is 1, it has come to 1 plus 8 percentage, and it has come to 1.08. And if it is 1.45, then what should be the base one? So 1.45 divided by, if you cross multiply, 1.08. Check now.
1.45 divided by 1.08.
Ah,
1.3425.
okay. So I'll tell you how to do. See, first of all, this step is okay. So they said 8 percentage. So I took the base value as 100. This is the opening value, closing value 108, because it is 8 percentage. So that means if it is 1 rupee, it has jumped to 1.08, because by increasing by 8 percentage.
Yes.
But now it has gone to 1.45, they said. So then that is what is the value of 1. That means X is value.
Yeah.
Okay.
Yes, sir.
This is fine, right? I'll move to the next one then.
Yeah.
The most likely reason for your country to encourage foreign direct investments while heavily restricting foreign investments in liquid domestic asset is to the most likely reason for your country to encourage foreign direct investments. The most likely reason for your country to encourage foreign direct investments while heavily restricting foreign investments in liquid domestic assets. The most likely reason for a country to encourage foreign direct investment while heavily restricting foreign investments in liquid domestic assets. Okay. Liquid domestic asset means where, say, for example, share market is a liquid domestic asset. You can quickly, come and buy shares here from India, and anytime you can sell and move away. That means you can easily take away your capital as well. But then if you set up one big industry over here, then you will not move away very quickly. So government normally prefers, foreign direct investments over foreign investments or foreign portfolio investments. Have you understood this?
Yes, sir.
Because if they invest in share market, they can remove money anytime, go away. But if they set up a business here, okay, industries or some business offices they will not go away overnight.
Yeah.
So that is the reason they may put restrictions on foreign investment but encourage foreign direct investments.
But I don't understand this. Foreign direct investment increases the production capacity of the domestic country. So then C should be correct, right? No.
They are encouraging. So C stabilize the production capacity of the domestic country. Yeah, but why are they restricting? The emphasizing word is here restricting foreign investments.
Okay.
This line C is telling you the positive point of FDI. Okay, good. But then if foreign investments are going away, then this C is also not making sense. Na, this one stabilize the production capacity. because if investments are going away, then there will not be any stability. But if business is coming in, see, if this business is doing very well, FDI, automatically foreign investments also will come in, and then they will stay within the country without leaving. But if this foreign direct investments is not doing well, even if by mistake if it comes in, okay, temporarily, they will go away.
Yes. Okay.
Still questions are there?
No, sir.
No, that's it. Okay. One minute. Hello.
Yes, sir.
Huh. Okay, so from here we are supposed to begin, right? Okay. Capital flows and the FX market, the foreign exchange market. Okay. The forward currency contract. Now, forward currency contract means what? It's a forward contract only. You are locking the exchange rate. Why will you lock the exchange rate? See, say for example, what is forward contract first of all? Forward means what? You are locking the price in advance. So why are you locking the price in advance? Say for example, you are Kalyan Jewelers company. So when you are Kalyan Jewelers, okay. So now your job is to import gold, convert it into gold ornaments, and then sell it to the public. Now, when you are importing gold, you have to pay in dollars. So you are importing gold. Now you are not going to pay immediately. You will pay after 3 months. Okay. Now your worry is, imagine if $1 you have to pay in dollar. So if $1 is 90 rupees, your worry is in 3 months. What if $1 becomes 92? So right now, if it is $1 worth of gold you are importing, after 3 months, to give this $1, you have to shell out 92 rupees. That is your worry. So what will you do? You will lock the price today itself for 90 rupees. This is called locking the price in advance. It's called forward contract. Is it okay?
Yes, sir.
Okay. Now, uh, okay. Then, similarly, uh, acha, $1. Acha, here itself I have told this is about exchange, right? So it becomes forward currency contract, because here currencies are in. I will give you this much currency, you give me this much currency. So this is forward currency contract, where the underlying assets are currencies. Okay.
Okay.
Then hedging. So what is this person doing here, Kalyan Jewellers? He's hedging.
Yes.
Then speculation. Speculation is speculation is uh, speculation is there is no need for you to do all these things. You are just locking the price in advance because you are speculating about the movement. So in this case, what will happen? Suppose if there is no need, Mr. X is going to investment bank and says after 3 months I will give you 90. You give me $1. Now imagine in the market this $1 becomes 92. So what will he do? Once he gets $1, he will sell it in the market for 92 and he will make 2 rupees profit. That is speculation.
Okay.
Okay. Then sell side and buy side. So sell side means basically these are all sell side investment banks. So originators of forward FX contracts are large multinational banks. So the primary dealers in FX, they are called sell side. And buy side is the one consists of many buyers of forex currencies and forward contracts. That means this is buy side and this is sell side. Okay. So the buyers includes corporations, investments accounts, then governments, retail FX market. All these are buyers, buy side. Then exchange rate, base currency, price currency. Now we have already discussed that one. Base currency is the, if I say $1 is 90 rupees, this is called base currency, the denominator one. The numerator is called price currency.
Okay.
Then direct quote and indirect quote. So direct quote is where per unit of foreign currency we follow direct quote. For $1, 90 rupees. Per unit of foreign currency, it is quoted in domestic currency. We say $1 is 90. Indirect quote is, if I say for 1 rupee, what is the dollar? That means for per unit of domestic currency, when it is quoted in foreign currency, it is called indirect quote.
Okay.
Then nominal exchange rate and real exchange rate. So nominal real exchange rate is the purchasing power, how much the purchasing power is changing. So nominal exchange rate is equal to inflation rate into real exchange rate. Okay. So exchange rate at your point in time is called nominal exchange rate. You can read all these things. Just you can read this entire paragraph also. Just read now, see if you are able to understand this. Actually, this is something you should read peacefully at home. Okay. Couple of times probably you might have to read. Then still if you don't understand, then you ask, okay, this part. Okay.
Okay.
Because reading FX topics, reading all this is good. This one we have already done, right? Okay.
Yeah.
So this one you just read at home. This entire thing I would say you read, try to understand. It is not given in a very user-friendly way, like a theory they have given all this, but still if you sit and write all this, the key points if you write, and then if you try to understand, your understanding will become much better then.
Yeah.
Then this part we have already done. Did you get time to go through this one?
Yes, sir.
You have gone? Okay, fine.
Yeah.
Okay. There is a video also in YouTube I had put up long back. If you search with nominal exchange rate, you should get it. Okay.
Okay.
Okay. Wait, I'll just send that to you. Otherwise, even that one you can watch. Mm. Yeah, I have sent it to you. Okay. In WhatsApp. Okay. Then next is real exchange. I think we did this one as well, right?
Yes.
Spot exchange rate and forward exchange rate. Spot is right now what is the rate? Forward is in future what is the you're locking the rate in advance. Okay. Then percentage change just now we have done, right? Percentage change, appreciation, depreciation, that part. Okay, so here it is not given properly as in like a theory kind of thing it is given. But if you have understood, with the sum, then you don't even have to read this. Okay. Or if you read it is good only, but it is not again very user friendly. You have to properly write the numbers on a piece of paper and then you read it, it will be easier. Hello?
Yes, sir.
Yeah,
Yeah.
okay. Then okay, you try this later on, okay? Model quiz. Then this also now we have done dollarization, countries that have their own currencies. This also we have done. Then balance of payment. Now, balance of payment means what? Basically, even on this also, there is a small video I did. I'll send that as well now. Wait. Uh, okay. So balance of payment. Uh, balance of payment. You can hear, right? Balance of payment.
Yes, sir.
Okay. See, balance of payment means one country's transaction with the rest of the world. One country's transactions with the rest of the world, whether it is in positive or negative overall. One country's transactions with the rest of the world. So overall, I have imported more or exported more, including capital also, with the rest of the world. So it comprises of essentially two parts: current account, not current account, I should say current account and capital account. Current account is current account is what? Current account. Current account is trade. What is that called? Trade deficit or trade surplus. Just 1 second. Hold on 1 minute. Hello.
Yes, sir.
Trade deficit and capital account deficit. Okay, that is uh, trade. Yeah, trade deficit and trade surplus. But there is a common. This is called balance of trade. Yeah, right. The common term is balance of trade. Okay. Then apart from this, uh, there can be other things like uh, apart from this, transfers are there, dividends received. Transfers means like aid. They are transferring money, during calamities and all. That also will go under current account. But this is the major chunk, balance of trade. Then capital account is foreign direct investments and foreign FII, foreign institutional investments, or also called foreign portfolio investments. Okay. So together it makes up to balance of payment. Is it okay?
Yes.
Okay. Then, so ideally, it should be balanced. Okay. So balanced means what? Uh, if current account deficit is very high, then they will make the economic conducive, or they will make the economy in such a way that they tend to borrow more money. So that means capital account will go up at the time. Foreign currency will come in. Okay. Or they will loosen up the policies so that there is more uh, foreign investments coming in, more capital coming in. So like this, they tend to balance it. Okay. Now here, see here. Uh, A large portion of the capital flows between the US and China are purchases of, they tend to purchase of US debt securities by China. China has a capital account deficit that offsets its trade surplus. So capital account deficit is there, but then they have trade surplus, okay, with the US. Okay, fine. Another thing is, this one is also an important one. You may get one question from here. See, it is see, GDP can be calculated. You know the formula to calculate GDP? Hello?
Yes, sir. C plus I plus G
Huh.
plus X minus M.
Yeah, correct. Okay. GDP is equal to C plus I plus G plus X minus M. Okay, that means this is consumption, this is investments, this is called expenditure perspective. Okay, all these are expenditure perspective formula. Okay, so there is GDP income perspective also that we will see. Income perspective, this is investment, then this is government expenditure, and this is export, and import. So GDP income perspective, it is C plus S plus T. This is consumption plus savings plus tax. Because all these are spending, we are consuming, investing, government spending, export minus import. Okay. And that has to be equal to somebody's income. That somebody's income will consist of their consumption, savings, and their tax. Okay. So that means C plus I plus G plus X minus M is equal to C plus S plus T. Okay. Then then yeah, this step is okay.
Yes, sir.
Now I can shuffle this and I can say this is my net exports, and I can say I minus I minus S is equal to is equal to uh, or I minus S plus X minus M is equal to I minus S and X minus M is equal to T minus G. This step is okay.
Yes.
So this is net investments or also net savings also you can say. Net savings plus net exports or net imports depending upon which is greater. Net exports or net imports is equal to net. This is net revenue for the government or net expenditure if government expenditure is bigger. So basically you can shuffle it the way you want. Say from this I can say X minus M is equal to T minus G, and then if I shift here it will be minus I minus S. We can say that way also. Correct? You understood this step?
Yes.
Okay. So this will be called as if you know, or I can write like this also. T minus G, then minus I plus S. So that is equal to T minus G minus I minus S. Okay, which I have written here. So this is net export is equal to okay. This is um, net exports, and then this is net expenditure or revenue minus net savings or investments. This is okay. This way you can shuffle it the way you want it, but basically this is the formula. And see here it looks easy, but when you see questions it may look little tough for you, because that's how the words will be twisted. See, say for example, if I say this is my net export, if export is bigger, then my net export is positive number. Now when will that be positive? When right hand side perspective, when tax revenue is going up, okay, and when investments is going up. See, when investment is going up, this number will be big. This number, no, savings should be big, no? 1 minute. Tax should be big, fine. Then if investments should be big or savings should be big. If investment is big, then this number will be a big number. And then if I reduce with this big number, then it will become smaller. No, savings should be big then. No? If savings is a bigger number, then this will become smaller. And then I'm reducing smaller number. Yeah. Savings should be high. Have you understood?
No, sir.
No?
Can you explain?
Okay, you put some numbers, you will get it. See. So T is, imagine 10 rupees. Government spending is 7 rupees. Okay. So, and then minus I minus S, right? So I is, investments is, investments is 8 rupees. Tax is 100 rupees. Spending is 90 rupees. Minus this is I. Investments is 20 rupees. Saving is 40 rupees. Okay, 30 rupees. Okay, so now what is export minus import? Net export will be 10 minus 10.
Minus 10.
So 20.
20.
Okay, now if I decrease this number savings, 100 minus 90, 20 minus let's say 10. So this will be 10 minus 10 equal to 0, right? So
Yes.
that means my savings bigger, export and export is will be bigger.
Okay.
Okay, like this you can put numbers and you can find out. They will ask you like this only, that if government expenditure goes up, what will happen? Like here, what have I done? Savings is going up, what will happen? So you put the numbers and then find out. Then you will come to know whether increasing savings is good for export or not. Then is it fine?
Yes.
Understood? So like this, you can shuffle this number thing. Okay. So now similarly, I can say T minus G is equal to what? T minus, acha, here already there, this one, this formula. And we can put any number and find out. They will say, see, suppose if the question comes, overall, if, savings is going up. Okay, just hold on 1 minute. Just
Yeah.
read this. Hello.
Yes, sir.
Okay. Uh, okay. Yeah. So here, till here, this is fine. Okay.
Yes.
Okay. Then see here, the trade deficit. This is trade deficit. Uh, Trade deficit means if import is more, then it is trade deficit. Okay. That means less than 1, they said. Na? That means import is more, so the answer will be negative here. Right? If export is 10, import is 15. Then 10 minus 15 is what? Minus 5. Minus 5 is less than 0. Okay.
Yes.
So if import is more, they are saying domestic savings are less. So let's try this one. This part. X minus M is equal to T minus G minus I minus S. This step is okay.
Yeah.
Now, if this is more, this is less. So if this has to be less, see how you have to understand, if this has to be more, then the first number has to be more. Okay. And this number has to be more.
Yes.
Okay. And because we are minusing, this number has to be more. Okay.
Yeah.
Now, because now we want this number to be more. So in that case, this number should be more and this should be more. Is it okay?
Yes.
So now let's try that one. 10 minus 15, or I'll take 100 minus 15 is equal to, or 100 minus 115 is equal to, no, this is 100 minus government expenditure is bigger. Okay, 115 minus investment should be bigger. So 30 minus saving is 20. So how much is this? 15 minus 10 equal to 5. Export minus import, okay, is equal to 5. Now suppose they said they want this number to be negative. No? So you increase this number further. So from government expenditure 100 to 150, increase it highly, let's see. And this number also 30 to 70 minus 20. So minus 50. Acha, sorry, this number is minus only, na? Minus 15 minus 10. So minus 30. Correct? Hello?
Yeah. Yes, sir.
Okay. Okay. Uh, so minus 50 minus uh, this is 50. No, minus 50 uh, uh, minus 50. So minus 100. Okay. Fine. Okay. So
Yes.
now they have articulated. Let me read this part.
Done, sir.
Ah, okay. These all are theory only, but you should read all those. Okay. Then
Okay.
exchange rate calculations. Exchange rate calculations. No. Okay. Just go through. Just read this. I'll explain them.
Done, sir.
Okay. Uh, 1 minute. Ha. So this one, see, have you understood this one or not?
Cross rate.
Ah.
I didn't understand the last para.
See, basically, if I say I'm trading with some sort of, let's say Mongolia, some country. Okay, now their currency. So if I say 1 rupee, 1 rupee is equal to, I don't know how many Mongolian currency. So how will I trade? Okay, Mongolian currency. And but then Mongolian currencies can, can be connected to US dollar. Let's say, let's say, um, $1 is, uh, 100 Mongolian currency. Okay, so now I can say if $1 is 100 Mongolian currency, for us $1 is 90 rupees. So I can say 90 rupees is equal to $1. So based on this, I can say 100 Mongolian currency is equal to 90 rupees. Have you understood this one? So therefore, um, if I bring this rupee down, it will be 90 by 100. So 1 rupee is equal to 0.9 Mongolian currency. Is it okay? This way,
Yes.
this is called cross rate, means basically you are finding the exchange rate between two currencies using some other common currencies. Third currency. See, when will you do? When it is directly not available.
Okay.
Fine, okay now? Okay.
Yes.
Then, so now you see this one. Mexican peso and Australian. So Mexican, okay. So, yeah, so now Mexican Australian dollars is equal to what? That is the question. Mexican Australian, Mexican USD. Okay, this is USD is 10.70 and USD by Australian dollar is 0.60. So now the question is, what is Mexican by Australian dollar? So see, I can write this as Mexican by USD into USD by Australian dollar. Okay. So this gets cancelled. I will be left out with Mexican by USD, AUD. Okay, but I'm not going to cancel here. I will write the exchange rate into 0.60. Understood this one? Just calculate.
6.42.
Okay, fine.
Yes.
Okay. Then let me see how much more is left. Just requires maybe like half an hour more. 12:30. I think we will stop now here. We'll just continue this tomorrow. Okay. Just
Okay.
half an hour more I need to do. Okay, and then
Okay.
this will be done. Okay.
Okay, so
Hello.
hello. Hello.
So I said, like, we will just,
Yeah.
I just need maybe like half an hour more. We'll just stop this now, and then we can do this tomorrow. And then after that, I'll start with ethics as well then. Okay.